Today, rates at a crossroads or not? Hi again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Today, I'm joined by Peter Marshall from Mozo. Hi, Peter.
Hey, Martin. Great to see you.
Well, thanks very much for coming back on. And look, there are so many things I want to talk to you about because the RBA, of course, surprised nobody and put the cash rate up last week. But what I'm interested in is what's happened since then to mortgage rates and deposit rates and all those things, because there are so many moving parts to this story, and I'm not sure that people necessarily will be following it all. But of course, that's your job, so you should be able to give me a very good view. Let's start with mortgages. So what's happened to mortgage rates since the RBA move?
Yeah, well, it's sure been busy. There's usually a bit of a lag between when the RBA announces its decision and rates actually start getting announced by the banks. But this time around, it's been a very quick start. Quite a few banks and non-bank lenders have already announced their movements, and quite a few have actually implemented increases. Like within a couple of days of the RBA announcement, we had already seen a number of rate movements.
And the point there is that quite often there's a sort of a lag, isn't there? And as you say, often the lag is a bit longer, but they sort of went straight for it this time, didn't they?
Yeah, they certainly seem to have their plans in place and ready to hit the go button and get on with getting more interest.
No surprise there. Macquarie was first, then CBA, and everybody else, lemming light, followed. There was no real standouts that I could see anybody who said, no, we're going to zig a different way. Everyone zigged and zagged precisely the same way.
Yeah, that is largely true. Although the thing that I did notice after a few days is that particularly for online lenders, so the non-bank lenders, they've been implementing slightly larger increases than 50 basis points this time, and a number of them have acted really swiftly on that.
And that probably underscores the bank's problem, which is margin compression. Of course, Suncorp came out with their results today, and one of the things that stood out for me was that they're having difficulty with margin. It is getting compressed. We're seeing it more broadly, not least because, of course, funding costs are now rising, and to an extent, some people are paying more on deposits. We'll come on to that in a second. But it looks to me as though the non-banks in particular are going to have significant funding pressures now because simply of the financial dynamics.
Yeah, it looks like they're struggling a bit at the moment. They don't have that deposit base to help cushion the blow of funding cost increases elsewhere. So they're having to pass on those increased costs to their customers.
And let's just talk about prospects ahead, because it's interesting that the markets now, which were at one stage significantly higher than where they are in terms of the forward view, is now saying, well, rates will go up a bit more, but then they're going to actually tilt back down again. And I guess the question is that yet having any impact on fixed rate mortgages ahead?
Yeah, look, it's certainly, I think it is starting to have an impact. We've seen a few shifts in the fixed market over the last week or two. The volume of changes has definitely dropped off. We're getting very few increases to fixed rates through at the moment. And, last week we even saw the Commonwealth Bank cut some of its fixed rates. It implemented a particularly large cut to its 4-year option. So that indicates that the banks are preparing for rates to not go quite as high as people had been forecasting.
And I guess the question is, with those rates now coming down, particularly the longer term fixed rates, that might mean a little relief for those people who are facing the cliff with their fixed rate refinance ahead, although it probably will be higher, but maybe not quite as high as previously expected. But do you think that the banks are still trying to pretty much price fixed rates so high to encourage people to go on the variable side of the equation?
Oh, look, of course they are. fixed is not where the banks want people to be at the moment. They want flexibility to reprice the vast majority of their loan book, depending on what the RBA does. But it is heartening to see that some of the heat has come out of that market. And I think if people are still interested in fixing rates, it might be worth waiting for another couple of months and just let that heat come out a little bit more, wait for a few more cuts to come through. And I think the market will normalise again. We've just been through an unusual crunch period as everyone got a little bit overexcited about what the RBA was going to do.
Indeed. Well, it's interesting. Some economists now are saying they won't even get to 3% terminal rate on the cash rate, right? Whereas a few weeks ago, everyone would say, oh, it's going to at least be 3.3 or something. So it's interesting how those opinions are changing. Not all the banks are playing the same furrow, of course. CBA seems to be the more conservative in terms of where they expect the rates to go. Some of the others, like ANZ, are still a bit more aggressive. But I think we're going to see more moves in terms of, these things. I guess the question for me, though, Peter, is to what extent can we insulate ourselves from what the Fed is doing? Because, of course, last Friday, the data from employment in the US was way stronger than a lot of people expected. So as a result of that, the markets are now saying, oh, the Fed's going to have to lift even more than previously. And I guess we have to take that into our thinking when we think about what the RBA might do, because if the RBA goes out of line compared with the Fed, the exchange rate goes the wrong way.
Yeah, they don't want to get too far out of step with the Fed. That creates a raft of problems, as you mentioned. But also, what the Fed does affects the price of money that the local banks are able to obtain overseas. So if the Fed keeps lifting its rates, then the local banks are going to have to recover their increased cost of funding somehow. And that will keep putting pressure on particularly fixed rate options.
And it's also true, isn't it, that the banks, continue to have to refresh their funding, which means that they're actually exposed to the shorter term rates as well as the longer term rates. And of course, at some point, they're going to have to start paying back that very cheap money, the term funding facility funds that they've got at the moment, courtesy of the RBA and taxpayers, because in fact the RBA is paying the money on the term funding facility that's sitting at the exchange settlement account. Not sure how that works, but that's going to make a significant dent in terms of their margins more generally.
Yeah, look, the banks are fighting tough at the moment, and they're really taking up the challenge to those online banks and online non-bank lenders at the moment. But I think that they're going to struggle to keep doing that longer term. They're going to have to really come to grips with reality about what their cost of funding is and pass that on to their customers.
Which means higher rates, unfortunately, which means that people are going to have to pay more for those old mortgages. But now let's talk about the deposit side of the house, because many of the banks have big deposit bases. In fact, as a proportion of total funding, deposits for a lot of the banks is higher than it's been for a long, long time. But how generous have they been with passing on the deposit rate increases?
A lot of banks have been really good, and we're seeing a huge amount more competition than we've seen in a long time in the deposit space. We're starting to see banks that haven't moved their deposit rates up since the RBA started increasing rates, suddenly implementing quite meaningful increases. Some of those banks might not be offering great rates yet, but it adds to the environment where there's a lot of competition. And we're seeing, even small mutual banks starting to lift their rates and become really competitive. And it's just lifting the whole market up for people who've got savings.
Finally, some people will say better late than never, because of course, a lot of people have really held money in the bank and got nothing for it for a long, long time. But again, you have to shop around, don't you, to get the best rates?
Oh, yeah. And, it's not only the best rates, it's about the conditions that you can meet. Bonus savings accounts can offer some decent at-call deposit rates, but they all have conditions. And, if you don't want to be bothered keeping track of how many tap and go payments you've made in a month, that can limit the options available to you. But having said that, there are accounts out there that are more simple and still offering pretty good rates.
Goes back to, shop around and don't just assume that the first one you come across is the best one. And one other thing with regard to shopping around, it's interesting that the ABS data showed that refinancing of mortgages was really, really strong, remarkably strong, whilst first-time buyers are sort of less active and even investors are a little less active. Refinancing is the name of the game. Not surprising because, of course, people quite often aren't on the best rates they could be on.
That's right. So there's a couple of things I wanted to mention on that front. There are plenty of lenders out there right now with really good cashback offers. So you can get, easily $2,000 cash, maybe up to $5,000, depending on your situation and who you're switching to. But there are just so many of these offers out there, trying to attract interest, trying to get people to commit. So it really pays to shop around and know what that cashback offer benefit is really giving you, even if it means paying a slightly higher rate. The other thing is, just anecdotally, we've been hearing some really interesting stories about the difference between the rates that banks are advertising and the rates that people who have been with the bank for a while are on. If you've been sitting on a fixed rate for a while, you'll roll off onto a variable rate. That variable rate may bear no resemblance at all to the rates that that bank is advertising for new customers. So, it's really important, particularly if you haven't checked your rate in a while, take a look at it, have a look at what's around, think about how much you could save by refinancing. There are calculators out there. The Mozo website has one that can help you compare what a cut in an interest rate will do for you. And it can make a huge difference of thousands every year really easily.
I think that's a really good point. Shopping around is it, and looking at those calculations. It's worth saying, of course, if you go to the bank sites directly, you'd only get the information about their mortgages and their calculator tied to their mortgages. But if you go to someone like Mozo, you get a view across the market, which means you've got a much better chance of finding the better ones. And I think it's also important to highlight that you've got to be careful, because sometimes when the refinancing calculations are done, they extend the life of the mortgage again, right? So you might go from 21 years back to 30, and that sort of looks, that's a really good repayment. And then, hang on a moment, I've just been extended by a number of years. So it's really important to check the term too, isn't it?
Absolutely. Make sure that you're not extending your term, because that's a sure way to be paying a lot more interest.
And then just thinking holistically, credit card rates really have not moved, right? They were up in the stratosphere. They're still up in the stratosphere. No real change there. So you wouldn't want to hold much debt on credit cards, would you?
Yeah, look, there have been a few credit card providers increasing rates, but I don't know that they're really terribly related to the RBA. I think it's more about those providers, repositioning where their products sit in the market. But yeah, if you've got a credit card debt and you're paying over, 12% or so, it could even be worth having a look at a personal loan, something that's got a lower rate, clear your credit card debt and stop paying interest that you don't need to.
Absolutely right. Don't help the banks with their profits, save the money for yourself. Now, two final questions. The first one is borrowing power, because there's a very important relationship between interest rates going up and a reduction in actually effective amount that you can borrow.
Yeah, so, as interest rates go up, the banks have to calculate how much you can afford to make repayments for. And as rates go up, the margin that banks apply has to be applied to the current rates. So, if you think about it, a year ago, you might have been assessed at a maximum rate of maybe 5.5%. Now you could be looking at being assessed at how much you can repay at, closer to 8%. So that will reduce your borrowing power. So yeah, it really pays to make sure that, you've got as much money saved up as you can, and you've got all your finances sorted out before you go to a bank and apply for a loan, so you can get, the best offer on the table as possible.
And of course, the trick here is if you are able to refinance and you reduce your interest rate, so you can actually reduce your repayments, maybe it's smart not to actually reduce your repayments if you can still make those repayments. and pay ahead and get ahead, right? Because we are going to expect more interest rates to come through. And if you're on a variable rate loan, that means that rates are going to go higher. Nobody knows quite how long and when and how. But actually building a buffer, if you can, really does pay, doesn't it?
Yeah, every little bit that you can save on interest now and get your principal reduced will save you even more in interest in the future. You're just looking at monthly payments at the moment, but over, if you're looking at 10 years left on your mortgage or 15 years, that all adds up enormously. The cumulative effect is incredibly important and powerful. And for depositors, it's positive, but if you're on a mortgage, you have the same effect, but in the negative.
And that's the point, isn't it? And I know that some people are horrified at the idea of paying down your mortgage. No, I just want to keep servicing it into the future. The point is, you end up paying so much more over that longer period. And it's not just a few dollars, it's thousands and thousands and thousands of dollars, right? Whereas if you can actually reduce the capital, that means you don't earn more interest or get charged as much interest, which means that you can actually pay down quicker. And the novel idea is, and it used to be quite often, you try and pay down more rather than just as long as the bank will give it for you. And that's a very interesting mind switch, isn't it?
Yeah, always make more repayments than the bank is asking for if you can possibly do it. The banks are out to make sure that they're maintaining their profitability. So they're very happy for you to just make the minimum repayments. But yeah, you shouldn't be guided by what the banks want you to do necessarily.
No, that's right. Look after your own finances. Don't assume the bank's looking after your finances, right? So last question then, Peter. RBA next month, probably going to put rates up again?
Oh, look, there seems to be a reasonable case for it. But, I am hoping that the RBA will take a little pause. As we talked about earlier, the pressure from the US Federal Reserve might make that impossible. But perhaps they'll limit it to just a 25 basis points increase in September rather than the 50 basis point increases that they've been applying so far.
Well, we'll keep our fingers and toes crossed because higher rates really doesn't help anybody with their mortgage. But the bottom line is you've got to own the problem, right? So, do the research, understand what your rates are, shop around, use the Mozo calculators and use the Mozo comparisons because it really can actually save you a lot of money. And I keep saying to people, this is the simplest way to save money is shop around and get the cheaper loan because they are out there.
Yeah, and even if you've looked in, say a year ago, things have changed a lot in the last year. Lots of lenders have become more competitive or less competitive, and you've really got to keep an eye on where those shifts are occurring to make sure that you're getting the best deal you can.
Yeah, great advice, Peter, because otherwise you end up with the good old apathy tax, right? Which basically is another way of saying is that you are just helping the banks to make more returns at your expense, and that is not a good outlook. So it really is important to own the problem, get that information, and frankly, in the current environment, keep checking because things do change quite quickly, don't they?
Yeah, the banks don't need our help. We should look after ourselves.
Great advice. Peter, thanks very much. As always, really appreciate it. And we'll put links and things below. And I look forward to catching up with you down the track again as, well, rates will move. They always do.
Great. Thanks, Martin.
Thanks. Take care. Bye-bye.